A very good morning to all of the students. So today is the last session of this 3-day inventory session, and today we'll be learning this inventory, taking further into detail, and we will also solve some CA foundation papers which came previous year CA foundation papers, and after that we will be lastly ending our session with some series of multiple choice questions just to revise your concepts and to prepare you for the upcoming foundation exam on January 2025. So we will go to the continue with first of all the practical questions what we have discussed and what is pending in the study material. So now we will come back to the questions. So here what we are seeing is as this is the practical question 2, what we have to see is the value of stock is asked on 31st March 2022, and you have got the following information. Now, with this information, which is there in this table about the value of the stock, purchases, manufacturing expenses, and sales, now I would like to ask the class that what is intended here in this question to calculate? The opening stock or the closing stock? Who can answer? What I am intended to calculate, the opening stock or the closing stock? Participants can raise their hands and they will be allowed to speak. You have been given the value of stock as on 1st April 2021, and you have to calculate the value of stock as on 31st March 2022. Yes, very good. Yash Pradhan has written that it is the closing stock calculation. Now, whenever you are trying to find the closing stock from the opening stock, just remember the basic formula, which you all know. Opening stock plus all the purchases minus cost of goods sold gives you your closing stock. Opening stock plus purchases minus the cost of goods sold to the closing stock. But when you are calculating the opening stock, the sign of this all becomes reverse. You add the closing stock and you get the purchases. So this is how we have I have given you the formula, and this is the basic way which will be operating. And almost if you see all the foundation questions, whether it is for 5 marks, 8 marks, 10 marks, all of these basically you can use this formula to get your answer and get marks on this. So I was scrolling through those questions, and all of these questions definitely one of the stock values given, and you're intended to ask. You are asked another stock value, and you have to calculate it accordingly. Now let us quickly look here. What happens is you have been given the value of stock, and you have been given the purchases. Now since you have to calculate the closing stock, opening stock, and you add the purchases during the period. So with the value of stock, purchases will be added. So there will be a plus symbol for the purchases. Then coming to manufacturing expenses, they are linked to the direct product. They will also be added. And you have been given the sales. Now what happens is we have to find the cost of goods sold. For that reason, we have to find what is the cost of goods sold. We need to find also the sales and what is the gross profit, because sales and the gross profit of the sales, if we deduct it from the sales, we get the cost of goods sold. So for that reason, every question they'll be giving, you can see here the gross profit earned during the year was 25% on cost. So every question in inventory technique, definitely there will be a gross profit percentage given, but it may be given on cost or it may be given on sales. If nothing is mentioned, it becomes sales. Now, if the gross profit on cost is given, then you have to calculate the gross profit on sales. Because if you calculate the gross profit on sales, then you can use that percentage to percentage of the gross profit on cost. From there, if you derive it from sales, then you can use it to find the cost of goods sold or the cost of sales during this period. Now, in this type of question, there is an additional information which is given to you that at the time of valuing the stock, a sum of 60,000 was written off in a particular item which was purchased for 2 lakhs and was sold for 1,60,000. This question I have already discussed. Just I am giving a brief review of this. Now, what happened is 2 lakhs you have purchased it, but you have written in 60,000 because based on the market value, you see that the value should not be that much. You written down the value, but it was sold for 1,60,000. what is written here in the next line is, but for the above transaction, the gross profit earned during the year was 25% on cost. That means this transaction is included in your normal transactions, and then you have to show it separately because this is an abnormal item. Because what happened? You purchase it for some value, you write down it for some value, and if you see the purchase price and the sales price is less than the purchase price, which is showing an abnormality in the transactions, which you have to show it separately. So as we have discussed earlier in the theoretical point of view also, abnormal items has to be segregated and shown separately. Now we can see here the gross profit is given. Now we have to understand what happens in these abnormal sales. Now, if you have a normal sales and this abnormal sales normal, in all the questions of inventory, the abnormal sales is included in these normal sales. And what happens is, definitely that abnormal sales will also give a profit, which is also embedded in this, because you make the entire goods go for sales. So this abnormal profit or loss, it can be also. Some questions which will be solving will be finding loss in that. So in that profit, you have the abnormal profit or loss embedded in it. So how to deal with this type of problems we'll be seeing here. Now, first of all, what you do is you have to calculate the gross profit, taking separately the normal profit and the abnormal profit. So first of all, to get the normal profit on the normal sales, you have to first of all deduct the abnormal sales from there. So what happens when you are calculating gross profit? First instance, you know that gross profit on normal sales is 20 by 100 because it is 25% on cost. So if it is 25% on cost, means 25 by 100. Consider cost as 100. Selling price is 100 plus 25, 125. So your profit margin is 25 by 125, 1 by 5.20. So that means 20% is your profit margin. So that profit margin is multiplied with sales to find the gross profit, and that 52 lakhs 20,000, which is the sales, from that you deduct 1 lakh 60,000, which is the sales value embedded inside the sales of the abnormal item. So doing this gives me a abnormal item sale. When you don't record it, 1 lakh 60,000, you deduct it from here, and you get 10 lakh 12,000 as your gross profit on the normal sales. Then what happens? Apart from this, you have also got the profit from this abnormal item, which you have got separately, and you also add it separately to calculate the total gross profit, which is including the sales from normal items and also the sales from the abnormal items. So what happens is you have written off 60,000. So the value comes 1 lakh 60 minus 2 lakh minus 80,000. Then you can show that yes, this is not my cost. Otherwise, what happens is 2 lakh total cost will be assumed to be there inside this sales. So actually, from that 2 lakhs, 60,000 has been written off, and you are getting 20,000 as the gross profit on that abnormal item. So what is the total value? Is 10 lakh 32,000. So you got the gross profit. So in such type of calculation, such type of problems, if it is given an abnormal item, immediately what you do in the first instance, calculate the gross profit, taking normal and abnormal items separately. So once you get the gross profit, now you can start valuing inventory, because now you can calculate the cost of sales. So what happens is you prepare a statement of valuation of stock as of 31st March. Okay, chapter 4 of the inventory, and I am dealing with the practical questions. So somebody asked me chapter or unit कौन सा है, please बता दो. Unit 4 inventory का है, और inventory का practical questions में हम लोग practical question number 3 में जा रहे हैं. ठीक है, उसके बाद हम लोग foundation का question solve करेंगे. So what happens is the value of stock on the 1st April 2021 is given to you. It is 7 lakhs, and you have been given the purchases during the period also. So as you're going towards the closing stock, with the openings from the opening stock, when you're going towards the closing stock, you add the purchases. So I added the purchases. Now when you add the purchases given 34 lakh 60. You also add the manufacturing expenses, and the total value you get is 48 lakhs 60,000. Now this is the opening stock plus purchases. Then less the cost of goods sold. That is the cost of sales during the period. Now for this cost of sales during the period, you require the sales, which is 52 lakhs 20,000, less the gross profit, which you got from your working as 10 lakh 32,000, which gives me 41 lakh 88,000. Then when you deduct it, you get the closing stock value of stock as of 31st March 2022, 6 lakhs 72,000. So this is the way we solve this practical question, the second one. Now we can, before going to the third one, I hope there is no doubt in this type of questions. It's clear. Okay, so now we can go to the question. This is the another practical question given in the book. The third question is profit and loss account of Hanuman. It is showing a net profit of 6 lakhs after considering the closing stock of 3,75,000 on 31st March 2022. Now you see here, this is a question, is a bit twisted question. What happens is, instead of asking inventory, it is showing the net profit. Because you all know that for the net profit, you need the gross profit, and the gross profit, you have the closing stock, definitely you need it. So from the closing stock, it is saying that derive the gross profit, and then from there on net profit. But what happened? There were some informations which needed the scrutiny of the books. What is this information is? If you can see here, the first information in this type of question, when you study the information that the profit is given, but what the information which says that there is a wrong thing happened. So now net profit is there, closing stock is given, but purchases for the year included 15,000, which is paid for new electric fittings. Now what happens? You have purchased inventory, but 15,000 is paid for the new electric fittings. It is an expense. So the expense item is added to the inventory of the purchases, which is showing you a net profit. But actually, there is even an expense item which has been added extra. So the purchases became more 15,000 in the gross profit part. Then what happened? Hanuman, he gave away goods valued at 40,000 in 3 samples. 3 sample goods which are given are not accounted in the inventory. They were not recorded in the books of accounts. So the 3 sample has to be booked here. There has to be charged on the somewhere, because 3 samples you are giving means you are incurring the expenses of the production of those goods. So definitely it has to be recorded somewhere. Invoices for the goods which are 2,50,000 have been entered on 27 March, but the goods were not included in the stock. So what happened? You got the invoices, you have entered it on 27th March, that these are the invoices, but the same goods has to be taken to the stock, which has not been. You have the invoices with you, but the goods have not been included in the stock. So this is another information which we received. And the last information what we received is in March 2022, this 2 lakh have been entered. March 2022, goods of 2 lakhs have been sold and delivered, were taken in sales for April. Now, what happened? You have sold the goods in March, and the sales have been taken in April. Now, with such type of information, you have to prepare a profit and loss type of adjustment account, memorandum account, just to see where the problem is. Now, what happens in this? You have another fifth information is a sale and approval basis. Any type of question in inventory, definitely one question inside that you need to submit, it will be either a consignment sales or a goods on sale and approval basis. Now, what happens? Goods costing 75,000 was sent on sale or return approval based sales in March 2022. And what is the margin? The margin of profit is 33.13% on cost. So whenever this approval was given in April 2022, what it's saying is, now when they sent to the customer in March, customer replied in April that yes, I will take it as sales. But what happens? Probably they were very confident that the customer will accept those goods, and they included it in the sales for March 2020. So you have to calculate the value of the stock as of 31st March 2022 and the adjusted net profit for that period. So you have got that profit. Actually, the what profit you have got, you have to check it and you have to adjust it, the value. Now let us see how this question is solved here. First, if we see net profit is being it's a credit account. So you prepare a profit and loss adjustment account and you bring net profit to the credit side. Now what happens in that purchases, you have overcharged the electric fittings in extra. So you bring it to the credit side by electric fittings 15,000, because it has been charged extra in the purchases, which you have to remove it. Then, which is an expense. Then what happens? You have sent the goods as free samples. Now, whenever we are sending goods as free samples, we are promoting our sales. It becomes an, we are giving a trial. It becomes an advertisement expenditure. So what happens? We have to debit the, we remove the electrical fitting expense wrongly included, and we debit the advertisement samples, and here you credit the samples, you include the samples, buy samples 40,000 in the closing stock. So you put it near the closing stock, and here you in the credit side it has been done, and in advertisement samples 40,000 has been recorded in the debit side, so that It is the actual advertisement expense, which is not recorded. When it is the free sample, it is an expense for us, so it has to be recorded. So it is recorded here and is recorded as removed out of the inventory, as showing the credit entry in the credit column side as buy samples. What happened? The stocks which are the purchase of March were not included in the stock. So you have to include those in the closing stock so that this is the purchases of March, which is not included. So 2,00,000 goes back to your credit side of this as a closing stock. Then, if we see the next event, sales, the goods were sold in March, but wrongly taken as the April sales. Now, the goods were sold in March, but it's wrongly taken as April sales, means it should come to the sales of the March sales. So it should be going to the credit side as the sales of the March. So you can see here 2 lakhs has been added to the credit side. Then what we can see that the goods are approved in April to be taken as April sales. What happens in the sales? It has been added to the sales of the March, but actually the approval came in April, so we cannot take it in the March sales. So to remove it, so to remove the sales from the credit entry of the sales, we make a debit entry, and what happens? The sale is recognized in April. So the cost of goods are 75,000 plus see the profit margin. We got 25,000 in cost, and so this 10 we get when you take the sales side 75,000 plus 25,000 1 lakh, and you get the adjusted net profit as 10,40,000. So this is the way you prepare your profit and loss adjustment account. Yes. Okay. Yes, go ahead. Please
Sir,
go ahead.
I'm not understanding profit and loss adjustment account. Sir.
Yes. What happened?
I'm not understanding, sir.
I cannot hear you. Please be clear.
What, sir?
I cannot hear you. Please be clear. What is your asking?
I'm not understanding profit and loss account, sir.
Which one?
Whole.
Okay. You're not understanding the whole thing. Now just I'll ask you. Why did you bring the net profit to this side, credit side? 6 lakhs.
No, sir.
When I'm preparing the profit and loss adjustment account, why I'm preparing the profit and loss adjustment account? Some goods which has to be recorded or the event which has been to be rectified were not done. So I'm preparing a profit and loss adjustment account to get the true profit. That is the adjusted net profit. To ascertain the true value of profit, which might not have been done. Correct. So some of the events which I found out, which are affecting the profit and loss account, I have got that events. Now I have to record it appropriately in this through the profit and loss adjustment account, so that I will get the correct profit, also known as the adjusted net profit. For that reason, I prepared internally a profit and loss adjustment account. Now you tell me here, what in the profit and loss adjustment account, there's a debit column and the credit column. Whatever is there in the credit column will increase the profit or decrease the profit.
Credit column, it increase the profits.
Very good. Credit column will increase the profit and debit column will
decrease the profit.
Debit column will decrease the profit. Good. Now what happens here? Net profit. Why I am bringing it on the credit side?
Net profit, because credits it increase the profits.
It's a credit item, so the nature is the nature is like a credit item. It's a nominal item. It's a credit item, and you are it's a nominal account, and you are bringing in the net profit in the credit side. Clear now? 6 lakhs.
So, but advertisement it is a expenses. So it decrease the profit.
So why I decrease it? Why this? First of all, now after the 6 lakhs, you tell me why electric fittings I brought to the credit side. 15,000.
Because it is a expenses.
But the expense was always taken on the purchase. Now, if I take it to the credit side, it increases my net profit. Expense should decrease my net profit. If there is any expense which comes, it should decrease my net profit. Correct or not?
Yes, sir.
But why I brought it on the credit side, which is increasing my net profit? That means I'm reducing this expense. Why I reduce this expense?
Yeah, sir. That's why I am confusing, sir.
Yeah, because it is wrongly included in the purchases. So I reduce it. Correct?
Okay, sir.
Okay. So you understood totally, or I will explain another each of this?
Okay, sir. Later I will read myself.
So then you can see this advertisement has to be included as expense, because goods you are selling at free samples, the goods which have been produced, the cost which has been incurred, you are selling it as free samples, then nobody will pay you money for that. So it becomes an expense. So it has to be included as an advertisement. Okay.
Okay. Okay, sir.
So, okay. Thank you, Gauri. So now
Thank you.
that, yeah, thank you. So but now we can go to the stock now. Value of this check. Yes. Yeah, Chaitanya, tell me.
Sir, this is a profit and loss adjustment account. That's why all effects are given reversely, sir, in it.
Yes, whatever is not accounted for has to be accounted. See, like closing stock. If you tell now, you tell me if closing stock increases, what will happen to the gross profit?
Sir, gross profit will be increase.
Gross profit will be
Increase.
decreased.
Yes, sir.
Why gross profit will be decreased?
Sir, because the profit is what deducted from the closing stocks. Means total sales.
Okay. Yes. So what happens is now what happens? We have to take on those items which has been wrongly recorded, and you have to take on those stocks which are not included. Correct. Now what happens? We found the gross profit taking some closing stock and account. Then from the gross profit went to net profit. But what happened is there were some events which we found that it has to be rectified. Now in that these events, what happened is the sample of 40,000 is to be included, which is not included there. The free sample of 40,000, correct?
Yes, sir, but it is problem of purely rectification. Then why it is come in inventory chapter, sir?
Okay, we are talking about electric fittings.
No, overall the problem is about rectification, no?
No, it is the problem is what happened is it is talking about a profit and loss adjustment account. Okay, so it is not also rectification because some stocks which were not included has been taken. Right. So mostly what it is trying to do is it is trying to ascertain the true value of the net profits. So based on those information which it has, it is trying to find the adjusted net profit.
Yes, sir, understand, sir. Clear.
Okay. Thank you. So once you got the stock as on 31st March it is given, then you can add the, now you have to calculate the value of the inventory. So when the stock is given, you add the purchases of March 2022, which is not included in the stock, that is 2,50,000, and also which are the goods which are lying with the customer approval basis. Now, as I've told you, if you go to my earlier slides, when I've talked about goods as a sale or approval, when it should be recorded at cost. Now, the thing is, that 75,000 of goods at cost were not sold in the month of March, but approved by the customer in April to be sold. So the inventory has to be recorded at cost. So that was not done because it was assumed in the March as sales. So the goods lying with customer on approval basis has to be recorded at cost. So you have added to 2,50,000, this 75,000. So you get the value of inventory actually on 31st March 2022 is not 3,75,000, but actually it is 7 lakhs. I hope the value of inventory is clear to all of you. So please look into that flow chart which I have given you for goods on sale on approval basis. When is the condition of goods on sale on approval basis is satisfied, and your most of the questions will be on sale on approval and consignment basis on recording of the inventory, how you are positioning inventory. Now, what happens is since this inventory has been sold, recognized in April by the customer, but not in March, even though it was set in March. So the goods which are lying with customer, the goods are not with you. The 75,000 goods, mind it is not with you, but you are recording it at cost as an inventory because in the March, the sale didn't happen. Okay. So this is the last practical question which we'll be solving, after which we'll be going to the foundation questions. Now, if you see here, in this question, physical verification is done on 23rd June, where the value of stock is 40 lakhs, but your value of stock is to be determined on 30th June. And in between 23rd to 30th June, this is the transactions. Now, what you understood from here is, I have done the physical verification on 23rd June, but I have to calculate the value of stock on 30th June. That means I have to calculate the closing stock here. I have the information on opening stock and I have to calculate the closing stock. Now, for calculating the closing stock, what all information we have? We have these four informations, and let us go through one by one of each of this information. First information is out of the goods which is sent on consignment, goods at cost what 2,40,000 were unsold. So this is regarding the consignment sales. So this company as a consigner has sent some consigning the goods on consignment to sell it, but out of that 2,40,000 goods were unsold. The customer didn't take it, and so that's what may have been reported by the consignor. Then purchases were made of 4 lakhs, out of which goods worth 1,60,000 were delivered on 5th July 2022. Now, you might have taken, the company might have recorded the purchases on the basis of invoices or bills. Taking a payment term on the basis of bills, the company has recognized these are the purchases on the set of invoices. But what happens? They found that out of this 4 lakhs, goods which are valuing of at the cost of 1,60,000, they are delivering 5th July, and you have to calculate the value of stock on 30th June. That means after 30th June, in 5th July, these goods were received. In the third point, we can see the sales were 13,60,000, which include goods worth 3,20,000, which is center approval. Now, what happens? This 13,60,000 consists of this 3,20,000 goods, value of goods 3,20,000, which is sent for seller approval basis. And half of these goods were returned before 30th June 2022. That means you imagine that the customer will accept all of them, but out of that, on the basis of sale on approval basis, half of these goods were rejected, and your sale and approval basis goods you receive 30th June, half of these goods. That means 3,20,000 by 2, 1,60,000 you received it before 30th June. Fourth point tells you about the profit margin. As I said, every question on inventory, definitely a profit margin will be given either at cost or at sales. Here it is given at cost. So profit margin is at cost here. Goods have sold at cost plus 25%. But there has been an abnormal sales here. A goods costing 2,40,000 had been sold for 1,20,000. So you have been recording a loss here. There is sold at cost, but 2,40,000 have been sold at 1,20,000. So now, considering each of these events, let us see how it moves around to give us our value of the inventory. First of all, as I said, our job is to first find the gross profit, because once we find the gross profit, then we get the cost of goods available for sale. Then we can go for opening stock, plus you will add the purchase, and then we get the cost of goods sold to arrive at the value of the closing stock. So normal sales has happened as 13,60,000. Out of that, your abnormal sales is that goods costing 2,40,000, which is sold for 1,20,000, which you deducted it. Then what happened? Out of the 3,20,000 goods, 1,60,000 were returned. 1,60,000 goods were returned. It will not consider to be a part of the sales. So that has also to be deducted. So 1,20,000 and 1,60,000, 2,80,000 has to be deducted from the 13,60,000 of the sales. And you 50% is only considered as sales in the sale and approval basis. So what you get is you get 10,80,000. Then we are calculating the gross profit since it is 25% on cost. So 100 plus 25, cost plus profit is selling price 125. 25 by 125 is 0.20. That means it is 20% on the sales. So gross profit on normal sales is 20 by 100, 20% into 10,80,000. So which comes to 2,16,000. Then what happens is we have the loss. Now we will include in this gross profit. Now we have got the gross profit, but the abnormal item must have created a profit or loss. Now, if the abnormal item has created a loss also, that has to be taken here. So loss on the sale of this particular abnormal item is 2,40,000 minus 1,20,000. It's abnormal sales. It is coming 1,20,000. So this from 2,16,000, this abnormal loss is detected, and you arrive at the gross profit of 96,000. So 96,000 is a gross profit. Now, once I get the gross profit, then I start going for the inventory calculation. So value of stock is given 48 lakhs. Now what happens is your stock of goods which is sent on consignment, the unsold stock, consignment inventory comes to 2,40,000 because you imagine that the customer will take it, but you got the information that customer will not take it. So when the customer is not take it, you will record it in your inventory and you have added it, even though it is with the consignment, you added it to your inventory of 2,40,000. Whatever purchases happened during the period has been mentioned, 4 lakhs. Out of this 4 lakhs, 1,60,000 is to be not there. So this is not there means they are delivered, they are reaching in 5th July. So that 5th July transaction is not there in your books, is not actual the purchase. So 1,60,000 you deduct it and you are getting 2,40,000. But what happened? These goods which are in transit in the purchase were actually received on 5th July. Now, what happens is there are different types of, it's not mentioned here, but students can write in the assumption. There are different types of payment terms which tells whether to record the goods which are in transit or not. Now, generally, if you see a free on board and shipping, free on board means the moment the goods are loaded on the shipment and it is starting shipping, you are taking it as a goods in transit at that point of location that is included in the stock. Otherwise, it is not included in the stock. Now, here, assuming that condition, and since you are confirmed that you have received the goods on 5th July, you take this as which is delivered on 5th July, you add it to a stock and it becomes your goods in transit on 30th June of 1,60,000. Then cost of goods which is set on approval basis. Now profit is 20, so 100 minus 20 is 80. So 3,20,000 by to 1,60,000, 50% has been not been taken, and those has to be recorded as inventory at cost as the flow chart I gave you. So 80% of this it comes 1,20,000. So this total additions give me 7,68,000. That is total when you add it to 48, you get 55,68,000. Now, once I added to opening stock, the purchases and all the goods in transit and unsold stocks on approval basis, then I have to deduct the cost of goods sold. So first I have to take the sales where I should deduct the abnormal sales. I get 12 lakhs. Then what I do is I deduct the gross profit from the working of 96,000. So I get 11,04,000 and this gives me the value of stock as of 30th June 2023. So from 23rd to 30th June, this is what I got the value of stock. Now, if there is any question here, you can ask. Yes, Ashwika.
Sir, like I can't understand the part of that COGS that 80% of 1,60,000. I don't understand that part, sir.
You couldn't understand the addition part, last line, cost of goods sent on approval basis, right?
Yes, sir. Yes, sir. Yes,
Okay.
sir.
Have you seen that flow chart where I have shown when the goods are approved by the customer and when the goods are rejected by the customer?
So, I don't remember that part, sir.
You please go through that flow chart.
Yes,
What it
sir.
says is plainly, I've drawn the flow chart for you people to understand. Plainly, what it says is unless the customer approves, you cannot take it as a sale. Okay, that is known as the goods on sale or approval basis. Clear? That point is clear.
Yes, sir.
Okay, so now what you see is if you go back to that event, what is happening here? If I go back to the previous slide, sales were 13,60,000, but goods of 3,20,000 were sent out of that. Sales is 13,60,000. That included this 3,20,000 means your sales were overstated. Your sales were overstated, saying that these goods worth 3,20,000 were sent for approval. And half of these goods were returned before 30th June. Now, what happened is these goods of 3,20,000 were sent for approval. That these sales will happen. But what happened is out of 3,20,000, you didn't get 3,20,000. Half a return means 3,20,000 by 2 is returned to the premises. So when it is returned? Before 30th June 2022. Before 30th June. Now, When the sales were made, they were made on 23rd June. They have found that what is the transaction taken place between 23rd to 30th June. Now, out of 3,20,000, if you divide it by 2, how much you are getting? 3,20,000 by 2, Ashwika?
1,60,000, sir.
1 lakh?
60,000.
So 1,60,000 went to customer, and rest 1,60,000 has to be not considered as sale. Now, so something is not considered as sale means that inventory should be recorded at cost because it gets back to the inventory. Is it correct or not?
Yes, sir.
So what happened is, what you did is this half of this goods which are returned. If you can see, first in the working notes, you have deducted 1,60,000 from the sales, isn't it? Are you able to see it? 3,20,000 by 2, 1,60,000 are deducted from the sales. Correct. Then what happened? Yes. Ashwika, are you able to hear me?
Yes, sir. Now I can hear you, sir.
Now you understood?
Sir, come again, sir. To
Yeah.
this part.
This is the return of goods which is sent an approval. It is deducted from 1,60,000 deducted because it is not considered as sales. From the 13,60,000, only from 3,20,000, only 1,60,000 will be considered as sales. The rest 1,60,000 is deducted from the sales. It is taken as goods return, which is
Yes,
sent an approval. Now, when this is deducted, what happens here now? Those item which is not to be recorded as sales is recorded at inventory at cost. So profit is 20. So
Okay. So balance 80 will be doing it.
Yes.
Yes, sir. Yes.
Okay.
Yes, sir. Thanks.
Now let us come to the question 5. Manish closed his books of account on 31st March each year. Inventory taking for the year is 31st March was completed by 10th April. And the stock available in godown is 4,50,000 at cost. Now these are the details of transactions that took place from 31st March to 10th April. Now you tell me, here I would like to ask the class whether we are calculating the opening stock or the closing stock. I would like to ask the class now, whether we are calculating the opening stock or the closing stock. Yes, Aman Gupta rating. Yes, Aman, tell me.
Sir, we will find opening stock here.
Yeah, very good, Aman. You have to find opening stock. Now, when I have to find the opening stock, closing stock, what I have to when from the opening stock, I was adding purchases less closing stock. Now I'll go reverse. When I have to find opening stock, I have to add the closing stock, and I have to add the cost of goods sold. Then I have to get to the opening stock, I have to add the cost of goods sold, and I have to deduct the purchases. Now I have to go reverse because the cost of the goods which are sold, which have gone to customer, I'll take it back. I'll reverse it, and whatever purchases fresh stock came, I have to take it out. So whenever I'm calculating opening stock, I'll add the cost of goods sold and I'll deduct the purchases. So this is one basic thing I'll keep in mind. Then let us go to each of the events which are giving me what are the information. You can see. 31st March 2024 to 10th April 2024, goods sold to customer is 1,10,000. Sales return is 10,000. So we'll see this question carefully. It came in June 2024 foundation exam, and the question is only a 5 marks question. This is a very recent question, but it gives you the idea that how the questions will come, what they intend to ask. So what happens is here you are given sales and you are given sales return. So you know that whenever you are going to show the sales, you have to deduct it from the sales return. You have to deduct it, and you have to show sales less sales return. But this will all be included in the cost of goods sold because this minus gross profit will give me the cost of goods sold. So here I will add this COGS. Now, while writing in the exam, whenever you get such type of questions, first of all, in the rough side of the working note, if you can write, must note it down first what you have to calculate opening stock, write the equation of the opening stock, and each of the event classify under whether it is COGS or it is purchases like that, then it makes your work easy so that you can correctly arrive at the true value of the stock. So here you can see here, I have just mentioned slightly COGS, it comes under COGS and it will be added to the inventory value. Then purchases has happened 85,000, including cash purchase. Purchase return has been 2,500. So this is my purchase less purchase return. I got my purchase less purchase return. 15,000 in the fifth point, 15,000 goods were received in March for sale in consignment basis. Now this is sale and consignment, out of which 60% of goods have been sold by 10th April. These sales are not included in the above sale. That means these 50%. So before that, I will show you in the purchase I have did a minus sign. So because cost of goods sold, I will add in purchases, I will add minus sign. Right. When you come to this consignment sales, which is goods which has not been sold by 10th April, these sales are not included. I will deduct it because now this sales which has been unsold sales, I have deducted because I am arriving at the opening stock. I'm not arriving, I'm just going the reverse. I'm arriving at the opening stock. So I'm deducting this sales which has been not included in the above sales, unsold goods. Then we have, this is the consignment sales. I'll explain this again when I go to the inventory value. So in the nearby those events, you are right, whichever is plus, whichever is minus, you'll be writing those things. After the stock was taken, it was found that very certain, very old slow moving items, which is 14850, should be taken at 9,500 to ensure disposal to an interested customer. That means a stock item which is 14,850, seeing the market conditions, it is taken at 9,500 so that it will be, it's a slow moving item, it will be disposed, and for disposal, we give it a lower rate than the whatever is the cost, and this is when coming under the loss on the revaluation. So what happens? You are giving, you have not sold it to consumer, but you intended that if this is the price, it will ensure disposal to an interested customer. So there is a loss on revaluation. As well, there is a profit margin given, but in this question, profit margin is given on cost, 25% on cost means you have to calculate the profit on the sales when you want to calculate the cost of sales. We have to find the inventory on 31st March 2024. You have data of 10th April, you have to go backwards, you have to go to the opening stock. The value of stock as on 10th April is 4,50,000. You add the cost of sales. For cost of sales, what you do is 1,10,000 sales minus sales return, you get it. Gross profit is 25% on cost. 25 by selling price 125 equal to 1 by 5 is 0.20. So 20% on sales, you get 80,000. So you get value of stock plus the price because you are going towards opening stock. So adding the cost of goods sold, you are getting 5,30,000. Now this you got the first part. So this is your COGS figure as I have mentioned here, and you have added it here. Now what we are deducting is we are deducting the purchases. Now when we are deducting the purchases, we are first of all deducting the purchase returns. We are deducting the purchase return. Then what happens? Whatever is the unsold goods, that is coming under the closing stock. So it should not come under the opening stock. So what happens? 60% were sold. So 40% of goods are now unsold. 15,000. So 40% has to be freshly recorded into the inventory. So that is already been recorded and there in the 10th April. So it has to be deducted. So 100 minus 1640. So 6,000 has to be, this 6,000 has to be removed from this to arrive at your opening stock. Loss and revaluation of slow-moving inventories, 14,8550 is there, 9,500 is that valuation, and you get 5,350. When you add all of this, 93,850. When you deduct from here, you get 436,150. So this is your total. You have subtracted it to get this value. So this is the very recent question of June 2024. Now, if you have any doubt, you ask me. So I think it is clear to all of you. This is a 5 marks question. We'll go to May 2022. This is also a 5 marks question. There is another question which is of 8 marks. We'll see to it later. So it depends on how much information they give. Accordingly, if the information is more, the marks awarded is more. So here we can see that 31st March 2021, you have got the information and value of stock is given, purchases, manufacturing expenses, sales. You have to ascertain the value of stock as on 31st March 2021. Now, April 1st, 2020, you are getting the stock value opening and you have to find the closing. That means you add the purchases, you add the manufacturing expenses, and you take the sales to deduct the cost of goods sold so that you can arrive at your closing stock. You have given 28 lakhs the value, purchase is given, manufacturing expense is given, will be added, sales which will be taken for deduction from gross profit, and the net value will be deducted from this value of stock for arriving cost of goods sold. So purchases and manufacturing expense will be added and sales will be subtracted. What is the information given is at the time of valuing stock, this is where the abnormal transaction happened. 2,40,000 was written for a particular item which was purchased for 8 lakhs. Now, item was purchased for 8 lakhs. You write down a sum of 2,40,000. And this item was sold during the year end as 31st March for 6,40,000. So, except for the above transaction, the rate of gross profit during the year was 1/3 of the cost. So, what happened is analyze the total, the first one. The value was written off. The value of 8 lakhs was written off 2,40,000, and that was again sold for 6,40,000. And here, if you analyze the second one, gross profit is 1/3 on cost. So 1/3 by 1 plus 1 by 3 sales, you get 25% of the sales. So the moment is given in cost, it starts calculating it on the sales. Now, gross profit on normal sales is 25 into this is the normal sales and this is the abnormal 6,40,000 will be deducted. Now, on the particular item, 6,40,000 minus 8 lakhs minus 2,40,000, you get the gross profit 80,000. So 51,40,000 is your gross profit which you get it. Once you get it, you find the value of stock, which is on 1st April, 28 lakhs. You add the purchases, you add the manufacturing expenses, but you deduct the cost of goods sold. For that less cost of sales during the period, you take the sales, you deduct the gross profit, and you get a COGS, which will give you the value of stock as of 31st March 2021. I hope it is clear to all of you. This question of 5 marks came in May 2022 exam. Now, this is a question November 2020. It is of 10 marks. Question is of 10 marks. Here, what happened is they did a physical verification of the stock was done on 23rd February 2022. The value of stock was found to be 28 lakhs. And the following transactions took place from 23rd to 29th February. So, what we have to find out, 23rd is given, 29th is given. Determine the value of stock on 29th February. That means I have to calculate the closing stock. Opening 23rd February, value is given is opening stock. I have to find the closing stock. The moment I have to find the closing stock, I have to add back the items like purchases. I have to deduct the items like cost of goods sold, like that. So let us see how will I think of the consignment sales and approvals. So these two are given. Number 1 point is talking about the consignment sales, and number 3 is talking about the goods sales and approval. So out of the goods sent and consignment, goods at cost were 2,30,000 were unsold. These are the goods which are unsold, which will be added back. That opening stock was there, we will minus the this will be added to the closing stock, so you'll be adding it back. So purchases will also be added. So in the working notes of point number 1 plus, point number 2 plus or minus, if you write it down, then while calculating the value of stock, it will be easy for you to remember. Then these two information becomes vital here to find your cost of goods sold. Because you have to take out the goods which is sent for approval also. Profit is 25%, cost at cost means 25 by 125 means per sales profit margin is 0.20. The third point is talking about the return goods. So how will we be treating about the return goods? We will see here. First, we are finding the gross profit by showing the normal sales and abnormal sales. Actual sales is 13,60,000. Less the abnormal sales is 1,50,000. Then what happened? You have the return of the goods which is sent in approval, 1,60,000 by return out of 3,20,000 by 2, 1,60,000. So then what you did is you found the 10,50,000 will be normal sales now. You found from the actual sales, you get the abnormal sales and goods sent in approval, you got the normal sales. Now, what is the gross profit of normal sales? Is 20 by 100 into that 10,50,000, you get 2,10,000, and you deduct the loss from there on that particular item of 90,000. 2,40,000, which is sold for 1,50,000. So when you deduct from 2,10,000, 90,000, you get gross profit as 1,20,000. So this is my gross profit. I got the gross profit at 1,20,000. Then, with all this information or data with me, I am now preparing the values of the stock as on 29th February 2020 because I get the value of stock on 23rd February 2020. I add any unsold stock out of goods which is sent out in consignment, 2,30,000, which is given. Purchases on this period is 3,20,000 minus that 1,20,000, you get 1,80,000. Goods in transit on 29th February, we showed that it is 1,20,000. The goods in transit is there. Cost of goods which is sent on approval basis, inventory at cost is, you have to record it, 100 minus 20, it is 20%, 80%, 1,28,000. Then you have to show the COGS, which you have to deduct it. Cost of sales during the period from 23rd February to 29th February, sales 13,60,000 minus 1,60,000, that consignment sales, we are taking it out. Deduct the gross profit, which you got from the working notes. And you got 10,80,000. So your value of stock as on 29th February is 23,70,000. So you can see this is one of the similar problem like your practice questions. So such type of problems, if you can solve, you are getting 10 marks here. If you have any doubt here, you can ask me. Okay. Now, this is a question which came on May 2019. Raj has prepared his accounts on 31st March. Due to some unavoidable circumstances, actual stock taking has been on 10th April 2009. And that where it was ascertained at 1,25,000. So this stock which has taken on 10th April, it was ascertained at 1,25,000. That means 10th April, when you are finding the stock and you have to get it back to 31st March, means you have to talk about the opening stock. First point is sales are entered in the sales day book on the day of dispatch and written invoice in the written invoice book on the day of goods received back. That means sales and written invoice, sales and sales return are recorded as and when goods are received or dispatched. Purchases are entered in the purchase book on the day the invoices are received. So the moment you receive the invoices only, you record the purchases, irrespective of the goods received. First, you will see the invoices means you record the purchases. If you see here, since you're going to opening stock, you have to add back the cost of goods sold that has gone to the customer. You have to add it back again. And here, that's why for that reason, you are taking the sales figure to add it to this value. So 1st April 2019 to 9th April, the sales was 20,000 as per the sales day book. Free samples for business promotion, which is issued during that time, is 4,000 at cost, and the free sample gets added back because you are going back to the opening stock now. Purchases amounting to 10,000, but goods amount to 2,000 not received till the date of stock take. Now, you got the purchases in the basis of bills, but goods amount to 2,000 is not received till you have done the stock take. This is where our event we have thought of 10,000 now, whether what you have to record here becomes a big question. Because out of 10,000 minus 2,000, 8,000 we have the goods, but 2,000 we don't have. So as a result, purchase will be subtracted. And this invoices for the goods purchased amounting to 20,000 were entered on 28th March, but goods are not included. So this is a purchase which is not included. Definitely, since it was not included earlier, you have to add it back. So you are adding it back these purchases because this goods has to be going back to your opening stock because it is not entered on 28th March. Rate of gross profit is 25% on cost. And we have decided the value of stock as on 31st March 2009. 25 by 125 is 0.20. Now we go to the value of stock, 1,25,000. Sales have been 20,000, less the gross profit, 4,000, 16,000. In addition to that, what happens is we have got the free samples. We have been issued as free samples, but earlier it was a part of the opening stock. So it gets added back. Purchases is deducted. As we said, COGS is added and purchase is deducted. So from 10,000, you are deducting 2,000 here because we cannot take this as goods in transit because we have no information whether goods are received later or not. We have all the information, we'll have treated it separately. So this is where we have to be cautious while doing it. Then add purchases, but it is not recorded in the stock. It should have been recorded during March 2019. So this type of purchase are added 20,000. So you get the value of physical stock. What you are doing is you are adding COGS types, you are deducting the purchase types. Then you are adding the purchases which are not recorded in stock. So you are getting the standard figures. I think there is no doubt here. If you have any doubt, you can ask me. So now we will go to the MCQ. Now there is a company which is following a weighted average method of valuations. So here I would please look into this because this will tell you how to find your closing stock from these values. Just analyze this question. In the meanwhile, I'll take a 10 minutes break and I'm coming back. So in the meanwhile, you can just analyze this question to find out how you can start practicing how to find your closing stock. So this is about a company which is following a weighted average method of inventory valuation. And date-wise, the details of its purchase and issue of raw materials during the week are given. On the 1st 12, 2022, there was an opening inventory of 50 units. Price is not known, but the method of valuation of inventory, whatever we received the information, the value is given rupees 2,200. Then what happened on 2nd December? Again, the company purchased some 100 units, but this time the price is at 47 rupees they purchased it. So they procured inventory at 47 rupees, around 100 units. And on 4th December 2022, they issued some 50 units in inventory, which went out of the stock. 5th December, they have again purchased 200 units at 48 rupees. What is the value of the inventory at the end of week, and what is the unit weighted average cost? This is what we have to calculate. So I think all of you have noted that first slide information. Now I will be waiting for an answer. I will give you a time also. Say, take 5 minutes and tell me what is the which option is correct, because we had two information we want. What is the value of inventory at end of week, and what is the unit weighted average cost? So I am waiting for the answer. Take your time and just tell me the answer here, calculate it. Or if you have calculated, you can raise your hands and tell me the answer. Chaitanya raised hands. Very good, Chaitanya.
Sir, option number D, 14,000 and 46.66.
Option number?
D. Sir, my option is slightly different. 46.33 RI, sir.
You are getting 46.33.
33.
46.33.
Yes, continuous.
Okay. and we are getting the value of inventory as 14,000.
Yes, sir, something around.
Means it's you are getting like a round of figure somewhere around 14,000 and 46.33, correct?
Yes, sir.
Okay. So, so that means you are choosing the option D.
Yes, sir, option D.
Okay. So Chaitanya has chosen the option D. Any other answer? So thank you, Chaitanya, for giving me the answer. So Chaitanya has option D. Any other person? Any other answer? We have. Where somebody has calculated it. We want to know. So I got the answer from Chaitanya. I will wait for another just a minute. If somebody is calculating, they can raise hands. Else I will start telling the solution. If somebody is calculating, they can raise the hands. That no sir, we are calculating. You need time. Okay, then I wait for a minute and then I will compute the answer. If anybody has any other options, because now I have finished the Chaitanya's option has increased 14,046.66. Anybody is coming nearer to that answer, or anybody else has to say something, they can say. Uh, Pranav. But yeah, very good. Yes, Pranav, go ahead.
D, option D, I'm getting.
Yes, Pranav, you can speak.
Option D, I am getting, sir.
You are also option D, Chaitanya's option.
Yes, sir.
So how did you arrive, Pranav, at the calculation? What you did actually? You can say in brief what you did.
Sir, that multiplied it.
Yes.
So number of inventory multiplied with average price units, sir.
Okay. So number of inventory you multiply with figure. Okay. Right. Okay. Thank you, Pranav. Now we'll start talking the solution. So what happened is, let us see the two participants reason. They have some other answers. Himanshu. Himanshu. Yes. Yeah, Himanshu. Himanshu, you want to say something? Okay. Aman. Yeah, Aman, you can speak.
Sir, I think option C would be correct according to me.
Option C means 14,300, 47.57.
Yeah.
Is it?
Yes, sir.
Okay, so how did you arrive your answer, Aman?
Sir, we have. So can you move to the question slide once?
Okay. Anyway, let us see. Yeah, tell me, Aman.
We have an opening inventory 50 units at the
Okay.
rate of 44, valuing rupees 2200.
Okay.
Then we have issued these 50 units at 4 December, I think. At 4
Why did you show
December.
these 50 minutes? There is no mention of method that before it is following weighted average. Why did we issue these 50 minutes from this opening inventory?
Oh,
Because
there is nothing I'm wrong
yeah,
here.
because that's my doubt. Because we have not mentioned whether it's LIFO or FIFO. So it can take it if it follows the LIFO, it can take it from 100. If it follows a FIFO, it will take it from 50. So there is nothing so specified. It is saying that it is following weighted method. So why do we take this number? So issued is 50, and again it is purchased 200 units at 48 rupees, right? So
You're right.
why we are taking that assumption when we are following a weighted average method? Okay, now let me talk to you your solution. What would have happened? Now this is what is the question, and the answer is 14,200 and 47.33. Now let us see how we are arriving at this answer, or the figure near to this. Are we arriving it? So let us see what has been done. How to calculate the weighted average cost of inventory, which I talked to you earlier. The same thing. Now you see, you have been given the date where opening is 50. Your value is given 2,200, right? But on 2/12/2022, whatever inventory issued at 100, the value is 4,700. Why? Because 100 into this 47 is 4,700. Clear? Now what happens is you are getting the total value of the inventory is 6,900 and the total quantity is 150. So 6,900 divided by 150, you get 46 rupees. Now this is the 46 is now the price at which your inventory is been recorded, because earlier it was 50. Now you got 100. Before any further purchase is made, weighted average cost takes into account all these values before you do any further purchases. Now what happens? 6,900 by 150, you are getting 46. Then what happened is you are again having on 4/12, you are having quantity of 100, which is at 4,600, because out of the total 150, you have issued 50. So you have now only 100. So 100 with that 46, it is getting you that value 4,600. This is the price at which you recorded the inventory. Then you have got 200, which you have taken the price as 48. So it comes to 9,600. Now, when you add 100 and 200 units, which is available for sale, it is coming to 300. And when you add 4,600 and 9,600, you are getting 14,200. Now, 14,200 if you divide by 300, you are getting 47.33. So that's why the value of inventory, that is the closing, is now 14,200, and the units which is available for sale is 300. So 14,200 by 300 is 47.33. I hope it's clear to all of you. So remember, whenever you are doing a weighted average calculation, always try to take the prices before the purchases, and from before the issues. Always try to take the prices before the issues. And once the issue is done, take that weighted average price and start with again new purchases till you get again new issues. So before any issues, you are recording the price, and that price you are calculating on a weighted average basis. So the first time when I did a weighted average in that slides, if you see that time the opening balance was nil, there was no opening balance. Now this is here, when there is opening balance, what you have to do is you have to go to, you have made any issues, record the price, freeze it, and then allocate it accordingly to the balance of the stock. Then you can add on the purchases and again find the new weighted average price. I hope it is clear to all of you. Now this question, if profit is 25% of cost price, then how much it is of the sales price? What can be the answer here? If profit is 25% of cost price, what can be the sales price?
Sir, option third, 20% of sales.
Yeah, very good, Chaitanya, for your answer. Now we'll come to this question. Profit of is 25% of cost price, and you have cost of goods available for sale. You have total sales. You have opening inventory of goods. You have got the gross profit margin on sales is given. And closing inventory for the year 2021-22. You have to find it. So just ignore this top one, profit is 25%. I'm just striking it out. So you are given cost of goods available for sale, total sales, opening inventory is given 50,000, gross profit margin on sales is given you have to find the closing inventory for the year. So I'm giving you 2 minutes time. You can check and answer. Or else you take 5 minutes time, see it carefully, and try to answer this question. So, is there an answer? Can anybody say what is the closing inventory? Yeah, Ashwika,
So 1,25,000, sir.
1 lakh,
25,000.
1 lakh. Very good, Ashwika. 1,25,000. The correct answer. So we will see. Closing inventory is cost of goods which is available for sale minus the cost of goods sold. So you have total sales minus the profit and sales and profit and sales is profit margin into total sales. So what you're doing is closing inventory, you're getting 2 lakhs minus this COGS 700,000, and that's where you get your inventory. I'll share this slide to you. Good. So we need to be that conversant with that concept of closing inventory. Very good. This one, what would be the closing inventory? When goods is purchased is 1 lakh, sales 90,000, and margin and cost is 20%. What should be the closing inventory?
Uh, Sir, it's
Yeah, Chaitanya, tell
25,000.
me.
25,000.
25,000. Yeah, very good. 25,000 the correct answer. Your margin in cost means margin and sales is 0.17. COGS is sales minus gross margin, 90,000 minus 0.17 into 90,000. So it is 75,060. So 1 lakh minus the 75,000 is 25,000. Good purchase is your cost of goods sold. Minus goods purchase minus cost of goods sold gives you the closing inventory. So the previous one and this one gives you more clarity on the concept of the closing inventory. So which of the following methods does not consider the historical cost of inventory?
Sir, retail price method.
Very good, Ashwika. So is the retail price method which does not consider the historical cost of the inventory. Now this is a typical way of finding a closing stock. All information is given to you. What would be the closing inventory as on 31st March 2024? I'm giving you 5 minutes time. Take comfortably 5 to 6 minutes and tell me the answer.
Sir, I guess it's 22,800.
Yes,
22,800, sir.
22,800.
Yes, sir, I
Okay,
guess.
very good, Ashika. So Ashika has been promptly answered the 22,800. Any other answers? I'm waiting for 3 more minutes to find any answer. Yes, Chaitanya has waited.
Sir, yes, it 22,800.
Yeah, Chaitanya,
Sir, same answer, 22,800.
22,800. So Chaitanya and Ashika has the same answer. We'll be waiting for some others for 3 minutes and we'll solve it. Yes, Ibrahim, what's the answer? Ibrahim, you can speak. You can unmute yourself and speak, Ibrahim. I think he has some network problem. He's not able to speak. So let us discuss this answer. This comes to 86,800. how it is happening is you have opening stock. See here clearly, you are having opening stock, and you have to uh, go back to the closing inventory. If value of stock is in 50,000, so 50,000 plus 32,000 plus 12,800. So it gives you 86,800. So then I'll give a complete revision now of whatever I have discussed. Go to the uh, first slide, and I'll give a revision on that. I'll just tell you the basic points which we have to remember. So, um, so this is the topics we had to cover. Just understand that we have to learn the basic techniques of inventory valuation, and the most importantly, when you find the CA foundation questions, they ask you to understand the methods of inventory record keeping. Right. So whatever the CA foundation questions came, they were only talking about the methods of inventory record keeping. So where we have to have a idea and you have to compare the intricacies related to the inventory techniques. So we had talked about the inventories, different costs of purchase, and how you calculate the inventories. It's the different basis of inventory calculation we talked. But this is how the total cost of inventory we understood that how it is coming, and what are the exclusions, abnormal wastage, administrative overheads, selling and distribution costs. These are all the wastage. And we talked about the net realizable value, the periodic and perpetual inventory system. We talked about the specific identification. We also talked about FIFO, LIFO, and simple average, how the closing stock changes under the methods. And we took an illustration here to understand how the inventory is going under the FIFO method and how it is going under the weighted average method, where the time the balance was nil given opening stock. So how we found out the weighted average, we found the price. Then most importantly, we talked about the adjusted selling price, the retail price method, and how to calculate the gross margin. So this is when we found the cost of closing inventory, and I gave you this flow chart for you all to remember how to find the cost of fixed %. And I discussed why this gross margin is hidden inside this and how to take it out and so the cost. I discussed with all these formulas. These formulas, you can write it down somewhere and practice it. It becomes handy when solving the problems. And I have discussed with these all problems how to solve it. So we have discussed what all to include in the cost of the inventory and how we are going to find the different gross profit margin and make the inventory valuation. The most important part of this is the inventory taking, which we found that in the CA Foundation exam, inventory taking has been more and often been asked than other concepts. because that's where practically companies face this reconciliation of inventories, because normally close to the year they may not be able to take. Sometimes they take before and after, and in between that the sales and purchase happen, and sales and purchase can happen. And we had talked about how to calculate the closing stock, and how to have the opening stock calculation. And this is how we have found out why the inventory on 31st December would be. When you have information, normally what problems, all the problems which you see, one day the information is given, you have to find the inventory in another date. So you had purchases, you had sales. Normally there is a markup or a profit margin given, and you have to, but the opening stock, from the closing stock, the going to opening stock, how you are doing it. You are adding the closing stock, you are deducting the purchases, and you are adding the cost of goods sold. So whenever questions are coming to you to find the opening stock, deduct the purchases and add the cost of goods sold, just reverse of the closing stock, because that's where the question is. And we solve such type of question, profit margin, and like this. And closing stock is very easy. You have always done it. Opening stock and purchases. Write down, you always deduct the manufacturing expense, you add it, and COGS also you deduct it, because it is the goods which is going out of the premises, and then you get your closing stock. So we discussed so many problems that mostly this we saw in the foundation is write-off issues were also coming. How to write off when sales is there, 50,000 as 48,000 value, purchases, gross profit, you have to find inventory. And we started solving such type of problems. I talked to you about the consignment sales, because we need to talk on consignments. Then this is where I have time and again I say that understand this customer goods on sale and approval basis, because this is where there might be confusion what to do with this stock. The question comes because very simply, when you are sending it to a customer for approval, and we cannot record it as sales unless it has been approved. Now, if you record it also, you have to remove it, because suppose we assume that customer will approve it, then yes, sales is recognized. But sometimes what happens is customer may not approve it, and that time you have to record it as a closing stock at a cost price. So to record inventory at a cost price. And moreover, the approval period, if it is expired, okay, you can recognize the sales. But if it's unexpired, customer decision is pending, then the stock is there with the customer, but if it's there, you have to record it as a cost price there. Think of it as a cost price. Then we have talked about the sales and sales return, how happens, and purchase return. This is what we have talked about the opening stock when going. Suppose you have got sold in approval and unsold consignment, how to treat with it. So you can practice your problems based on this type of flow chart on these equations. So we have talked about how sales return affects sales and approval, and what happens basically in the sales and approval, how the billing is from them. This problem has been solved. And we have talked about unsold goods. Here the 4-week period, the expiry time period we have talked, the time period which I have discussed. So it will help you for understanding the sale and approval basis. We have taken some inventory figures. We find out profit margin is there, how to find the sales margin, profit margin on sales on this. So we have calculated those cost of goods sold, purchases, and we have taken all of these things to find that how mostly this loss on revaluation of slow moving inventory. This is one of the typical questions which can also come, that very old slow moving inventories, the loss on that old and slow moving inventories, how this will be calculated. Definitely, if there's a question given, this is the item, this is taken at this, that means you have to find out there is a loss. How is the loss? You have to just find out this manner. This is another way also. They can say 15,500 and customer has estimated to take it 12,500, so you reduce the value accordingly. And then how you make it what the treatment you give in the valuation of inventory. I've given these equations to you to find out this is what we another found such a foundation question that sales are entered in the dispatch and goods will receive back, but purchases are entered once the invoice is received. So that's a typical problem is solved even in the foundation, even in this illustrated practical question also. So how to deal with such type of problems? We have talked about the goods invoicing and how we are reducing the goods wherever it is not recorded. Value of the stocks. So as we can see, abnormal sales, always this type of situations comes. Profit will be abnormal profit or loss. Then you have to calculate the two types of profit. One is the profit in the normal sales transaction. Another is the profit on this after this write-up, abnormal sales. So both profit has to be added, and that profit has to be deducted from the sales to arrive at the cost of goods sold. Here we have talked about a profit and loss adjustment account, new type of method here given here. Instead of stock taking, you are going to profit and loss adjustment account, and you are adjusting your stock accordingly to get the true value of profit. Then we have found how goods are lying with customers on appeal basis when they are, the sale is not made, you are recording at cost. And the dates are given, how you find that which one is consignment sales, the event are given, which is sales and approval. And then you find your normal sales, deducting the goods which are sent and approval and which came back. And your abnormal sales you deducted to find the arrive at the gross profit. Then you use the equation to what to add and what to purchase less. You add the purchases and less the cost of goods sold. So that's how. Now, if you see the June 2024 exam, clearly you can see here that the inventory taking at different dates. Then the question is asked on basically inventory taking and how you are, which one you have to add and subtract. You have to decide, then only you can go to the value of inventory for inclusion in the final accounts per year and the 31st March. So how to calculate the value of inventory? They given some information, and this is how the question is asked. So using that as a table form, we can very correctly to understand what is to be added and what is to be deleted, then definitely can answer this question. In May 2022, when the question was asked, here everything is given simply the data to find the closing stock. But what happened is this write-off of issue is given, the item was sold, and you calculate the gross profit accordingly. So this is how May 2022, you can see adding purchases expenses and subtracting cost of goods sold. Similar November 2022 also the transactions from 23rd to 29th is given, and it's asking you to find out the cost of goods sold. So you have taken track of which are the return goods which will come in the COGS, and we deducted the abnormal sales, return of goods which are sent for approval. Then loss on the sale of particular abnormal goods also has been taken. And then it always we calculate the gross profit. Now once we calculate the gross profit, then we have also goods in transit. Now this is where I have clearly discussed with you where you take the goods in transit, where a date is mentioned. Okay, you can assume that yes, this is the date the goods have been received. You take the goods in transit and record it at cost. Now when we see here, there is another problem related to free samples and how we have solved the problems with the free samples. Whenever you're adding the stock on the value of the stock, but while going to the opening stock, you are adding this free sample because you have used it for sale, but that has been, it is there in the opening stock now is used as sale as advertisement expense. So you can add, subtract, and then we talk some MCQs how the inventory valuation has been done. And with respect out a lot of MCQs. We discussed about the concepts. So once you look through these MCQs and this flow chart, it is enough to just help you capture your CA Foundation Inventory exam. So this is what my intention is to tell you that the more you practice, even if I give you these slides, the more you practice, the more you can perform better. You have all the information with you, just you have to arrange it, have to present it and answer the questions well. Definitely, then you can do well in the exam. So all the best. Thank you, all of you. And this ends the inventory session. Okay, thank you. Have a good day and all the best.